Welcome back and on to corporate conversations. Then Embassy REIT is the first management on the show. After a good fourth quarter, revenues rose 15% on strong leasing, and we are now being joined by Ritwik Bhattacharjee, who's the CEO at Embassy REIT, who is joining us. Ritwik, good afternoon. Thank you so much for joining in.
Nice to see you.
And you spoke about your FY25 leased area. You exceeded your guidance that you had projected for 5.4 million square feet. You delivered 6.6. How are things shaping up now, and what are you projecting for the new financial year?
Well, first of all, thank you very much for having me on the show. It has been a bumper year for us, and we couldn't be more pleased with the way things have panned out. We leased 6.6 million square feet and beat initial guidance by 24%. Most notably, we grew distributions by 8%, the lifeblood of a REIT, as you know, and we're pointing to double-digit growth in FY26. And really, it's fundamentally predicated on the fact that business for us and business in commercial office in India hasn't looked better. If you just think about the fact that there is active dialogue between a lot of GCCs who are still rushing to set up shop in India for the talent, for the ability to service their entire operations out of here, we're the fundamental beneficiary of that in our portfolio. We run a 51 million square feet portfolio that continues to fire on all cylinders. We've got 6.1 million square feet of development coming up that is highly yield accretive, and by any single parameter, we are firing on all cylinders and feel very optimistic about the year ahead.
Optimistic about the year ahead, and that sure shows in your guidance. You've guided for distributions in the range of 24.5 to 26 per unit for FY26. So largely, where is this kind of growth that is expected to come from, and how much growth over the longer run can we expect from you? Also, could you also speak about the occupancy levels that you're seeing?
Sure. If you really think about sort of where office is right now, we're really still in an early cycle as compared to maybe you see sort of residential, obviously sort of falling off a little bit. But that is something that's predicated, again, there are GCCs coming in. We see it, so the 10% growth that we are projecting at the midpoint next year is something that we feel very comfortable thinking about, making that sort of a fundamental sort of going forward. We are putting in 3.2 million square feet of development over the next year, and that's in, cities like Bangalore, which is India's biggest market. We have 75% of our portfolio there, and just really the best assets, we think, sort of in India that cater to companies like JP Morgan, Novo Nordisk, and other bellwether names. Occupancy for us is over 90% by value, if you just look at how big our portfolio is, and we think that ticks up to the mid-90s over the course of the coming quarters.
Bangalore, you said it's your largest market with 75% of your portfolio. Any plans on bringing that number down just to avoid that concentration concern?
We don't view that as any sort of concentration risk. In fact, that's something that we consider to be a strategic weapon for us. If you look at Bangalore, which is India's largest office market, and I know there's a lot of talk about being Silicon Valley and all of that, but for us, it is absolutely a fundamental, the biggest weapon in our arsenal. And we are pan-India. We're in Mumbai. Our portfolio here is 100% occupied. We expanded into Chennai. We are in Noida as well, and we're in Pune. Really, a pan-India portfolio of 50 million square feet, and having Bangalore there that continues to fire on all cylinders for us is something that we consider to be very important.
Sure. And, a couple of quarters ago, there was a development that came through on the SEZ demarcation. So, what is the kind of conversions that you expect from SEZ to non-SEZ, and what would be the occupancy levels there?
Yeah, so we've actually done sort of 6.6 million square feet of denotification and demarcation, and we've got a couple more million square feet planned. That process, I think the government's been extremely pragmatic and helpful in making sure that the conversions and that process is something that is as easily facilitated as possible. What was obviously a lot of uncertainty in the market has just become very routine and run-of-the-mill. So for us, we don't even actually think about sort of the SEZ conversion process. What we do see is demand firmly falling in the non-SEZ space. Our portfolio by the non-SEZ numbers is around mid-90s at this point in time. And we are opportunistic and continue to evaluate denotification and demarcation as the opportunity presents itself in our space.
What about the hotels portfolio, Ritwik? And if you could share a mix between the two, where is it skewed towards right now? Mostly office, yes, but how is the hotels portfolio shaping up?
Our hotel portfolio is a very small percentage of our entire asset value, right? But what we see is the hotel business is really picking up for us. EBITDA growth was 25% year on year. We're looking at, and these are business hotels. They're not sort of on the luxury end of the market, but they're following the boom in office, because there is clearly travel. You can't sort of get a room anywhere in India these days. If you think about, the quality of the hotels that we provide our office tenants as well, and it's really something that we feel will continue to grow in the quarters to come.
So are you looking to expand that and ensure that people get rooms?
Well, we are building out 2 hotels in one of our, marquee parks at Embassy Tech Village in Bangalore. But beyond that, no, we're not a hotel portfolio business. We're an office business with the hotels acting as an ancillary part of it that we continue to make sure provides value.
And what would be your outlook on the kind of rentals? Are you expecting any sort of growth-related concerns on the rentals, especially given how the economic situation is panning out globally, especially from the global clients? Do you see them sort of slowing down on their decision-making with respect to leasing out of spaces?
No, look, at this point in time, we've got potentially, 20 million square feet of RFPs in the market. Bangalore and GCCs continue to dominate that conversation. And I think for global clients, if you really think about, rentals per se in India, they're a fifth of, what they play globally. So that's never really the biggest sort of item when you think about sort of the cost proposition of what India is. India is very cheap relative to what you pay in markets like New York or Hong Kong or Singapore. So I think what they look for is scale. What they look for is obviously the talent base. And I think rental growth will continue to sort of be somewhere in the mid-single digits, as we've sort of seen in the past. But it's a very, very attractive proposition for all the companies who continue coming to India.
What about debt? Final question. You refinanced around about 6,000 crores this time around. What's the balance sheet looking like? Any plans on trimming debt down this year?
Yeah, so we're a 32% LTV book. We're very, very prudent about the way we think about debt. And that's around 20,000 crores of debt. I think fundamentally we rely on debt to obviously fund this business. And I think our fundamental focus is to make sure that, we're always prudent on interest costs, on making sure that we get the best financing rates. So we think we're the best credit in real estate credit in India. So, and we aim to make sure that we get the best rates at all times.
All right, Ritwik, thank you so much for spending
Thank you.
time and joining us. Wish you good luck for the rest of the year as well. And the management there of Embassy OfficeParks REIT, a good quarter and even better projections for the current financial year.